bring in our next guest. He's Jeff Palma, the Chief Equity Strategist at UBS Securities. He's been talking about how you might want to now have a more balanced portfolio. You've been holding cyclicals. You may want to offset that now with defensives. I want to bring in Jeff into this conversation. Of course, Dominic here with me as well. And Jeff, why do you think we're at a point where we need to see something more balanced in your portfolio?
Well, compared to the last couple of years, I feel like we're at a stage of the cycle that we're seeing a maturing recovery. And what that means is that all the tailwinds that we've seen from an earnings perspective and from a growth perspective, which have really driven the cyclical sectors, are starting to moderate. And that just means that continuing to press that very pro-cyclical trade is probably not the way to continue, especially as things like the ISM and leading indicators start to peak out and turn sideways.
And yet we just had a guest on earlier, Jeff, Michael Shaul, who argues that corporate earnings we're just, midway into this point where companies are rebuilding their inventories, that there's a lot more ahead in terms of record earnings growth for companies.
Well, I think we're still going to see strong earnings levels, but I think the best news on growth rates is probably behind us. On a global basis last year, earnings grew more than 40%, and that was on pretty anemic top-line growth, and that's because profit margins were able to expand up towards record levels. So I have no problem with the idea that profitability is going to stay high. It's just that the ability to continue to cut costs at this stage of the cycle is pretty limited, and so we're likely to see earnings growth more in the 10 to 15% range going forward.
Now, Jeff, it's Dominic here. One of the things that a lot of traders, a lot of analysts are concerned about right now is this idea that if we do see this correction here, if it is a correction that's coming, is it just a bump in the road, so to speak, for the bull run to stay intact? Or is this a situation here where you think that we could see a real turning point in the markets? Is this a turning point or just a chance to maybe buy the dip, so to speak?
I would think we're in the latter camp here, Dominic. I think that it is kind of a mid-cycle slowdown, a soft patch, if you like. We're still very much of the view that this economic recovery is a sustainable one and it's a durable one. Ultimately, that means that earnings growth can continue. It means that risk premiums can fall, and it ultimately means that equity markets can go higher, even if it's not the cyclicals that are driving that rally.
Well, Jeff, one of the concern right now, we're about a month or so, maybe a few weeks away from the end of Fed stimulus and quantitative easing too. Any concerns that stimulus removal will have an impact on the markets overall?
My personal view is that what we've seen as far as the rally in equities over the last 6 or 7 months has been mostly about the improvement in economic fundamentals, not QE. Of course, at the margin, QE has mattered, and it's certainly mattered within FX markets and probably some degree to commodity markets as well. But I think for equity markets, the key issue is that we should still expect the economy to recover, and if that's the case, markets to move higher, even if the Fed is starting to back away from its QE program.
Jeff, what have you made so far of the equity markets and commodities moving in tandem?
Well, I mean, I think over the last couple of weeks, we've seen a risk-off trade. Broadly speaking, we've seen this pullback in commodity prices. And even if you step back over the last, call it 2 years, the rally in equities and the rally in commodities has all been about growth. Yes, there's been an element of risk appetite there as well. I think the more cautious tone within equities and the pullback within commodities is more of a risk-off trade, maybe a little bit of a concern about soft patch. I think as we go forward, we should expect these markets to, broadly speaking, move in line with each other again.
So I'm trying to figure out then, Jeff, from what you're saying, are you, forget the U.S., are you then bullish on emerging markets as well?
We are positive on emerging markets over the balance of the year. We think that underlying growth is going to hold up pretty well. We think that the worst news on inflation is behind us. We like the valuation case in emerging markets also. And so, again, despite the recent underperformance, we think that EM can bounce back over the balance of the year.
Well, Jeff, one of those concerns about the emerging markets right there, if it's not inflation, is this idea that things really are slowing down. Even with China, a lot of economists out there ratcheting down expectations. Is that enough to power global growth, even if expectations are coming down for those markets?
Well, we're clearly in a situation where the recovery in global growth, while it's sustainable, is quite weak. On a global basis, this is the weakest recovery that we're seeing in the post-war period, and a slowing outlook in China doesn't really help the growth prospects over the course of the next 12 to 18 months. But what I would argue is that a slowdown in China is better than an overheating China. If we get to a point where things are overheating and you have to see an aggressive policy response that results in a hard landing, that would be a far worse outcome.
Could be the lesser of the two evils, basically. Jeff, thank you. Jeff Palma over at UBS.